Imagine applying for a loan and getting rejected in seconds. No conversation, no human explanation, just a message saying your application was declined. You check your income, your payment history, and your expenses, and everything looks normal. So why were you rejected? The answer might not be a person making the decision. It might be an artificial intelligence system analyzing your financial life in ways you cannot see. For many years, credit scoring was based on simple financial indicators like repayment history, debt level, and credit duration. Traditional models tried to measure risk using structured financial data. But today, AI-powered credit scoring systems are changing how lending decisions are made. Companies such as FICO use machine learning models that can process thousands of behavioral signals in seconds. Tech giants like Google and Amazon also invest heavily in predictive algorithms that analyze digital patterns. The promise of AI credit scoring is accuracy and speed. Loans can be approved in minutes instead of days. Financial institutions like J.P. Morgan Chase and Goldman Sachs argue that AI helps reduce human bias and improve risk prediction. In theory, machines do not judge people based on emotions, appearance, or personal prejudice. They only follow data. But the problem is that data itself can carry bias. AI models are trained on historical information, and history is not always fair. If certain communities were denied financial opportunities in the past, the algorithm may interpret that pattern as higher risk, even if individuals inside those communities are financially responsible. The system does not understand social justice, it only recognizes statistical correlation. Another major concern is the black box nature of modern AI. Many credit scoring algorithms are extremely complex, and even developers may not fully understand why a model makes a specific decision. When a human loan officer rejects an application, people can ask questions. But when an algorithm rejects you, the explanation is often vague, such as insufficient creditworthiness, without showing which behavior triggered the decision. Modern AI credit systems also analyze alternative data beyond traditional banking records. This can include utility payments, online shopping behavior, subscription activity, and sometimes even digital interaction patterns. Some experimental platforms have explored using behavioral signals as risk indicators, although such practices remain controversial because they expand financial surveillance into personal life. Privacy is another serious issue. To build powerful predictive models, companies collect massive amounts of user data. Your browsing habits, device information, transaction frequency, and sometimes location signals may become part of a risk profile. While companies claim this improves lending accuracy, critics worry that financial evaluation is becoming a form of digital monitoring. There is also the risk of feedback loops. If an AI system consistently denies credit to certain groups, those groups will have fewer opportunities to build positive credit history. Over time, the model may continue seeing them as risky because of missing data, creating a cycle that is difficult to break. Supporters of AI credit scoring argue that it can actually help people with limited financial history. Someone who pays rent and bills consistently but has never used a credit card may still be approved through alternative data analysis. In developing markets, AI-driven fintech platforms have allowed millions of people to access microloans and financial services for the first time. However, expansion of access must be balanced with ethical oversight. If algorithms are designed primarily to maximize profit, the system may prioritize short-term financial gain rather than long-term fairness. The objective of AI matters because machines optimize whatever they are programmed to optimize. Regulators around the world are beginning to pay attention. Laws related to data protection and automated decision-making are being discussed to give consumers more control over AI judgments. Researchers are also working on explainable AI models that can provide clearer reasoning behind credit approvals or rejections. The truth is, AI is a tool shaped by human design, data quality, and ethical boundaries. The future of finance will depend on how responsibly these technologies are developed. The dark side of AI in credit scoring is not that machines are dangerous by themselves. The danger appears when powerful algorithms operate without transparency and accountability. So the next time you receive an instant loan decision, remember that behind that result is a complex network of data and mathematical predictions shaping modern finance. If you want a fair digital future, understanding how AI systems work is the first step toward protecting your financial freedom.